Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I trust you had a restful weekend and as always have a productive week ahead. Let's begin today's video with the banking industry. China's banking industry valued at $55 trillion by assets. Chinese analysts warn that domestic banks will likely continue to see acute weakening in profits this year as net interest margins were heavily squeezed by loan rate cuts and rising deposit cuts in 2022. Chinese financial media outlet Caixin writes that while on the surface things look positive, quote, with the year starting off with a bang, China's banking sector issued a record 10.6 trillion yuan, $1.5 trillion of new yuan loans in the first quarter, which soared 27% year on year, end quote. However, despite the fast loan growth, quote, many listed Chinese banks remain pessimistic about the outlook for net interest margins, which may still face a squeeze like last year. Many banks reported slower earnings growth or even lower profits for 2022. End quote. The country's 6 biggest state lenders saw growth in net profits slump to 6.7% on average last year, only about half the pace of 12.7% in 2021. The difference between interest earned and interest paid out is called the net interest margin. According to Yicai, in 2022, the so-called Big Six, as well as 10 listed national joint stock commercial banks, saw net interest margins narrow by roughly 13 to 14 basis points on average. This appears to be the leading cause of squeezed bank profits, a process which has been ongoing for almost 4 years now. Caixin, in a different article, writes that the margin pressure was particularly heavy last year due to lower lending rates and elevated deposit cuts. Pressure on bank profits was also in large part due to government directives. We remember in 2022, in order to stabilize the shaken housing market, an issue which we'll touch on again shortly in the video, regulators directed banks to slash the 5-year national LPR rate, a reference for home loans, by 35 basis points to 4.3%. This once again reminds us that every policy action has a reaction. Some non-economically trained commentators have asked, if most of China's debt is owned within China itself, why not just trim it down? But of course, such a move would have systemic effects within the system itself. What is debt to some actors within the system represents assets to other actors. What is an interest payment by some is income to others. Much of the debt is held by banks, so if the state decides to, say, trim debt by 20%, they are also trimming the value of assets and income to others, like the banking sector, by 20%. And of course, this doesn't even take into account the devastating hit to market confidence in the debt market such a move would make. The shrinking of net interest margins has caused many banks to increase loan volumes in order to compensate. However, a nervous central bank has told the Big Six not to do this. Indeed, recently the deputy governor of the People's Bank of China said that banks, quote, shouldn't blindly pursue a fast expansion of capital, end quote, but should rather, quote, properly handle the relationship between stable growth and risk prevention, end quote. We will continue to keep our eye on the space. Next up, China's EV industry is also an area we have been watching closely for some time now. The massive business is beginning to challenge established automobile players around the world, but it faces as many challenges as it does opportunities. According to a new report published by the industry group China Automotive Battery Innovation Alliance, Chinese battery makers cut production in April in order to clear inventories amid slower sales of electric vehicles, but the report argues a rebound is expected in May. In April, Chinese production of EV batteries decreased 8.3% month-on-month to 47 gigawatt-hours. Output was still up 40% year-on-year, however. Battery installations in vehicles declined 9.5% in April month-on-month, but remained up almost 90% year-on-year, though we note these year-on-year comparisons are from low bases, as many cities this time last year were in lockdown. The reduction reduction in production is primarily due to a large stockpile of batteries and cooling sales. According to the China Association of Automobile Manufacturers, China's new energy vehicle sales dropped 2.6% month-on-month in April to 636,000 units. As we have seen, however, exports do look promising, though commentators point out that the sector is heavily subsidized, so it's hard to know just how competitive the industry would be without these subsidies. Meanwhile, US EV maker Tesla Inc. has recalled almost every car that it has sold in China due to a braking and acceleration defect that may increase crash and safety risks. In a statement over the weekend, the State Administration for Market Regulation announced that Tesla will deploy an over-the-air software fix to vehicles produced in Shanghai from January 2019 through to April this year. This represents over 1.1 million cars. Tesla has faced several high-profile PR incidents in China in recent years. Perhaps one of the most infamous was at the 2021 Shanghai Auto Show, which attracted international attention at the time. At the show, a woman climbed onto a display vehicle and accused the US carmaker's sedan of nearly killing her father because of failed brakes. Under pressure, Tesla published data logs of the vehicle showing that the woman's father was speeding well beyond the speed limit, 118 kilometers, 74 miles per hour, before the accident. Despite this, however, state media and government pressure forced the US EV maker to publish a public apology and commit to looking into the problem. And who would blame them? Tesla's China revenue was more than $18 billion last year, and the company's Shanghai factory was responsible for more than half of its worldwide output in 2022. Next up, new data indicate that hopes of housing market stabilization may have been premature. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Over the weekend, US financial media outlet Bloomberg produced an excellent report exploring the most recent data on China's housing sector, data which show that the sector remains far from stable, let alone healthy. The Bloomberg report argues that China's housing sector is regressing after a brief recovery. High-frequency indicators in recent weeks, the outlet writes, show momentum in home purchases has fizzled, and other analysts agree. Quote, after a short-lived recovery in February-March, the release of pent-up demand for home purchases has come to an end. The property recovery this year will only be moderate. End quote. The Bloomberg report points to 6 warning signs from recent housing market data. We are now quoting the report directly. 1. New homes. Home sales were dismal over the 5-day Labor Day break in May, the first long holiday since China abandoned pandemic restrictions and infection waves eased. New home purchases in 40 major cities tracked by data provider China Index Holdings were 22% below pre-pandemic levels in 2019. The 4 major cities, which includes Shanghai and Shenzhen, showed a sustained recovery, but in regional centers and smaller cities, sales plunged 28% and 42% respectively. 2. Existing homes. In the existing homes market, which is less distorted by seasonal factors linked to the launch of developers' projects, sales were even worse. In the 4 days in May, second-hand residence sales plunged 44% by area from a month earlier, according to brokerage Zhongtai Securities. The downturn is a worrying sign, as analysts had hoped a sustained recovery in the existing home market would eventually lift new home sales. 3. Unstable prices. The decline in prices of existing homes started to widen again since March, reaching a 4-month high in April. 4.
Inventory. Slower property sales have led to a glut in inventory. Unsold homes have climbed 43% from a recent low in November 2021, around the time home prices began their downward spiral. In 100 major cities, new home inventory, as of the end of March, could take about 17.4 months to get sold. 5. Mortgages. The outstanding amount of individual mortgages saw the smallest increase on record in the first quarter compared with a year ago, reflecting households' reluctance to add debt. Demand for home loans is weak due to consumers' pessimistic outlook for income growth, concerns about delays in new projects, and a shift in views about the long-term value of the sector. And 6. Real estate investment. Investment in real estate contracted at a faster pace in March versus the previous month, reversing the improving trend since the end of 2022. This suggests the rebound in home sales earlier this year has been insufficient to shore up confidence among developers, who continue to scale back land acquisitions. Thus it seems that China's housing market is still very much in crisis. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Monday wherever you are, and I will see you all tomorrow.